Right, well, inflation eased a peg in February, though it still remains high overall, putting the Fed in a tough spot with the recent bank failures complicating the central bank's objective of bringing us back down to that 2% inflation target. Well, for more on the outlook for the Fed's next rate hike, let's get to William Blair macro analyst Richard de Chazal. Thank you so much for joining me this morning. So, Richard, I want to ask you because obviously we saw CPI come in with expectations. Core CPI, though, still coming up a tick higher, especially what we saw with the jump in services as well. Can the Fed really breathe a sigh of relief at this point?
Yeah, I think this inflation report, which a lot of weight had been put on by the market, was encouraging in the sense that it was fairly boring. I think a difficult scenario would have been if the inflation report had come in much above the consensus expectations. And the fact that it generally met expectations was encouraging. But as Brooke just said earlier, I think what we're seeing is, disinflationary forces continuing to come through, but inflation as a whole is still too high for the Fed's liking. And I think as a result of that, what we'll probably see, and as we're seeing some of the market tensions ease around the Silicon Valley Bank, that I think paves the way to at least one more 25 basis point rate increase at next week's FOMC meeting. Powell earlier had sort of put on the table or paved the way in his recent testimony for perhaps doing a 50 basis point rate increase. But I think in light of the circumstances, that would seem to be off the table at the moment.
And do you think we'd be in this position if we took Silicon Valley Bank out of the equation and it just focused on the latest CPI data? Would 25 basis points still be the move, or do you think because it's been compounded that it now takes that 50 basis point hike off the table?
I think if you had taken Silicon Valley out of the equation, I think the odds would still be on 25, but wouldn't quite be as favorable in that direction.
And so one of the things that we heard Powell say is, they want to keep an eye on lag. We've heard that more and more in the conversation here. So then when you look at what was essentially a stress test for the banking system with SVB's collapse, then what does that, do you think, reveal about the pace and the speed and the size of the rate hike so far?
Yeah, I think it is absolutely symptomatic of monetary policy that is having its intended effect of tightening financial conditions in the economy. I think what we are seeing is that economic growth is slowly being suffocated. I think we're seeing that in many of the leading economic indicators, which we watch very closely, in particular the yield curve. We've seen a very sharp decline in building permits. We're seeing the money supply decline. And we're also seeing some of the more coincident economic indicators, things like industrial production. And as Brooke was even mentioning earlier, consumers starting to downtrade a little bit, maybe into private label. So we are starting to see economic growth slowing. And I think some of the tensions that we're seeing in the financial markets with Silicon Valley are a testament to that.
So then are there any opportunities to be found in this sort of environment where we still have this uncertainty about what the Fed is perhaps going to do after this current meeting?
I think, we are going to be in a tighter financial market environment for some time to come, with inflation still at 6%. I think even if the Fed, slows the pace of those rate increases, it's certainly telling us it wants to see policy remain tight for a while. We'll have to see what, if anything else appears on the horizon in the financial market environment in the banking system. It seems like that's off the table for the moment. But I think, we are looking at a more difficult economic environment over the coming several quarters.
And do you get a sense that the worst of the Silicon Valley Bank contagion and the fallout is behind us at this point?
It seems like it. I think the Fed has put forth a very powerful new BTTP. facility, which is very significant. I think that should help to backstop a lot of the immediate pressure on the assets or forced sale of assets to meet depositors' demands. So I think, I never say never, and I think what we're seeing in the market today is indicative that we are working through this. The Fed has been pretty quick to address this situation. The banking system as a whole is still very sound. And I think that's quite positive from that perspective.
I do appreciate you joining me this morning for your insights. Richard Chazal there. William Blair, macro analyst, thank you for your time.